Okay, we're live. It's time for Be the Boss of Your Money. We have a couple of important things to talk about. Let's just address it right off, right at the top. Stock market is getting plunged. Broken. Broken is the way that I would describe the stock market. Um, Most stocks have more than given up their post-pandemic gains. And right now, it's like a race right now to. This isn't for everybody, by the way. It's like a race to lock in whatever gains are left or to convert to cash. Not for everybody, but clearly the market's going down. There's no sugarcoating this, but I want to use this opportunity as a warning, and not a warning where I'm saying you should sell, go to cash, or you know batten down the hatches, hide in the bunker. That's not what I mean. Okay, just hear me out. For most of us, the overwhelming majority of us are not doing anything. Okay, I'll speak for myself. This is how I'm doing things, and this is how I'm managing things, and this is what I believe is the prudent way to go. Don't get tempted to make short term decisions. Just like when the market was flying high, we talked about here on the show. Don't get tempted by short term thinking and chasing the pandemic stocks and chasing the stocks that are flying high. It's the same thing now. Don't get caught up in having and thinking you have to sell, or you hear in financial media. If you hear in financial media, someone says, "Oh no, you should be all in oil. I'm all in oil stocks." And the next person says, "I'm 100% in consumer staples," or whatever. You have to realize these are hedge funds, these are traders, these are people that could liquidate their entire net worth and then put it all back in at some other time. And what they're trying to do is completely different than what you and I are trying to do. I really want to warn you, don't get caught up in the negative calls. Just like I said, don't get caught up in the overly bullish, optimistic calls. My screen is blinking like crazy. I can't stand it. I'm sorry, guys. I tried to figure it out. I actually think I'm going to have to get some new switchers and cameras and stuff, but that'll be fun for me. All right. So don't get caught up in listening to the negativity. Like, I have to get out of everything. The market's going lower. You will cause more harm than good over the long term, I believe. As Peter Lynch once said he sees people lose more money trying to protect themselves from down markets than the down markets themselves. In other words, people are really causing their own long-term troubles for themselves by by reacting to short-term market volatility. We're going to talk about that, some things to do, some things to take a look at. I don't want to make this a bitch session, bitch and moan about how much the market's down. It's down X amount here. The stock is down. We could go through all the stats of how things are down and how, technically speaking, things are looking pretty crummy. We'll do a little bit of that, but I want to put in the optimism, okay, of why. Sorry about that. Of why we're investing in the first place. We always talk about, if the market goes down, I'm in it for the long term. It's a very different thing when you're going through it and that fear hits you, which is an emotion, and then we start to do things that we swore up and down that we wouldn't do before the fear hit us. All right, so let's roll a quick intro. I hope that wasn't too long, but let's get the intro going, and we're going to talk about a couple things. We're going to take it to the boards, check out the market, have everything finished up, and where I think things could be, or what I think what we need to look for next. Okay, so here's the intro. Here we go. Stick around. If you have any questions, please hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. I see you out there, Jerry. Thank you very much. It was great to see you today. Now, here's the intro. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's about personal finance, investing, taking control of your money. If you have any questions, hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. And while you're watching this, whatever platform you're on, be it Facebook, LinkedIn, Twitter, or YouTube, leave me a thumbs up, a reaction. Let me know you're enjoying what you're watching. Let me know that you're getting value out of this. Plus, I get to see your name up there. And even if you're watching this in the replay, I will see it and get back to you, especially if you have any questions. I want to see those. And that to me is the best part of doing this. So replay or not, live or not, let me know what you're thinking. All right. So markets tanked again today, although not as dramatic. You know, there's nothing more dramatic than saying the Dow is down 1,000 points or more. It was down in the 600-point range. That doesn't even tell you the story. The Dow of the major averages, Dow, Nasdaq, and S&P 500, is holding up the best of them, down maybe 13-14% from its high. The S&P 500 is down 17%. So we're not too far from going into that 20% down market from its high for the S&P 500, which would put it officially in bear market status. And the Nasdaq is down over 20%. So the Nasdaq is in a bear, but I think we know that we've been in a bear market for quite some time, especially when we look at individual stocks in a case-by-case basis. There are so many stocks that have been pummeled 20% or more in the last year. The pandemic stocks really peaked early 2021 and have been going down ever since. And what we've talked about is it's just that most people who are investing, let's say, in index funds or an asset allocation model or just mutual funds, whatever, probably don't notice how bad things are because the biggest stocks have been holding up. So as a result, the major averages have been holding up. So you haven't seen what happens when like a Peloton is down like 90% or more, or Netflix drops 75% from its peak. By the way, you cannot invest directly into an index. I have to tell you this. You can invest in a fund or a security that tracks or mimics an index. Okay. But you can't invest directly into an index. There is a difference. And although index funds track an index, there is a slight difference. They might not trade exactly the same, or if there's a slight expense ratio for some index funds, things like that. Okay. Jerry says, great to see you too, man. We had such a good lunch today. Jerry and I caught up, went out to lunch today. Haven't seen you in person for a while. So great to see you, buddy. And looking forward to the next one. Who else is out there? Eric. Eric is out there. Eric, thank you. It was nice to see you at the Chase event last week. Eric is an executive at Chase. They put on a terrific event called Getting Back to Business last week, and I enjoyed the event thoroughly. It was just, the speaker was fantastic. All right, so let's talk about some warnings here. Again, I'm not into the. It's too late now for like the warning. I told you so. I told you should have sold it. I can't stand that. You're going to get a ton of people all over the place doing that, saying that. I told you so. Too late. Everyone has to find their own path, or you delegate it, right? What you delegate it to a financial professional, financial advisor. We've been talking about the ARK fund, ARKK, the MEME ETF, MEME, and if you follow me, I negative on these. I told you what's in them, why I think they went up, why I think they would go down. So not necessarily, I gave you the facts and let you make the decision. But they were loaded up with Roku, which went from like over $500 a share to the 80s. That's like a $50 stock going to $8. This is Roku. This is like a really popular stock in a popular company. So when you see Netflix down 75%, I think you start to get a sense of how bad things really are, especially if you are investing in individual stocks. Okay, so just have to say shout out over here. Nice. Where did you go? We went to Tao, the new Tao on Route 110. It's that new little shopping center in the same parking lot as the Uncle Giuseppe Shopping Center. Very good. I've probably between eating there and ordering it from there, I've probably had their food like 10 times now, and it's always happy with it. Okay. Business Insights. There we go. That's right. Business Insights. Okay. So let's not get caught up in the negativity, because now that things are down, it's time to, when things were up, maybe you could have gotten negative or been protective of your portfolio depending on what your goals are. But again, most of us, we're just going to hold on to what we have. We're diversified, and we're going to ride out the ups and the downs, reinvest, keep dollar cost averaging into the market, and this too shall pass, and we'll be okay. I've never seen the stock market not recover. Have you? It's always recovered, and when it recovers to new highs. And people who stuck with it are grateful they did. The people who just say, "I'm not really worried about it," who take kind of like a very nonchalant, boring attitude. Those are the people that do the best, in my opinion, because they're the ones who aren't over trading their accounts to death. They're the ones who are just saying what they're doing, what they say they would do, in it for the long term. Diversification. Diversification is a strategy that we use to minimize risk. It doesn't necessarily protect your portfolio from going down in a generally down market. So that's one warning. It's one thing to take a look at. The other thing is when people, professionals, are telling you, you should be in consumer staples or all in energy stocks, things like that, or my portfolio is 80% cash. That's what I advise people to do. You have to realize that uh, these people are not necessarily retail investors, which is what you and I are, who are just saving for a long term and investing for a long term goal. These people are doing something different. They have a mission to earn quarterly performance. We have a mission to earn a return based on our risk tolerance and our time horizon to our goals over the long term. It's a completely different ballgame. Now, if you are someone who's into individual stocks, hopefully you didn't binge on the DoorDashes, the Zooms, the Teladocs of the world, the Pelotons of the world, the AMCs, the GameStops of the world, because my own opinion is I would really be concerned about whether or not you ever recover from that or not. But that's up to you, and that's a different story. But I don't want to get sucked into the negativity and have you think like you have to sell, the market's going to hell in a handbasket, the world is over, and whatever you have left now is all you're ever going to have. You have to make that last for the rest of your life, what it is now, and just go to cash, live on beans and bread for the rest of your life. That's not where we're going with this. Okay, we are going with that. This too shall pass, because it always does. Always. The Federal Reserve will be where it needs to be. All right. Supply chain disruptions will eventually be solved. Inflation will moderate and come down. We'll even see, this is the toughest thing to talk about, but the war in Ukraine. Listen, if Ukraine didn't have, if Ukraine wasn't the breadbasket of Europe, and if they didn't have specialty chemicals, well, the proximity to Europe, I don't want to come off the way, the proximity to Western Europe, to our NATO allies, just makes it such a problem. But Ukraine is a major deal because it's such a breadbasket producer. It's one of the biggest wheat producers in the world. So just supply chain disruptions in China because of COVID. China gets a few cases of COVID, they shut down. You think, we restrict. China's like, forget about it. They get a case of COVID, they shut down a city of 15, 20 million people. All right. Howie's out there. What is the purpose of diversification? Everything is down. It's quite elementary. And you could stick that up your alimentary. You get it? Elementary. You get that? Okay. Diversification in a down market, it doesn't necessarily protect your portfolio from going down in a generally down market, but it could help your portfolio recover quicker because your portfolio is not completely made up of the investment that is down the most. There could be investments in your portfolio that are actually up on a down day as well. It also helps protect your portfolio from from disappearing. If you have all of your money into one investment and the investment goes to zero, it disappears, you would not have all of your money in that one investment, so your whole portfolio wouldn't disappear. It also could help your portfolio go down less than the overall market, which means your portfolio could recover faster. That's important, isn't it? And it moderates your portfolio. So if the market is going up here, down here, maybe your portfolio will stay in this range like that. That's the purpose of diversification. It's to make for a smoother ride. It's so an investor does not panic out of the market from too much volatility and then miss the upside. I want clients to be diversified enough so that they could stick it out, not so undiversified enough that the portfolio drops so much that they have to get out, make the emotional decision of selling everything when it's down and doing something rash. That's the purpose of diversification. It's a good question. People think, what good is it? But what if you had all your money in crypto, in Bitcoin? We're going to get into that. All right. So that's my warning of the day. Not a warning so much as how bad the market could be and how high interest rates could go up and we could go into a recession. We talk about this stuff every day. My warning is different. It's to not get overly caught up in the negativity, because this too shall pass and you'll be the better for it, for sticking it out and being the long-term investor that you said you were. Now, if you're older, you're retired, you're no longer investing monthly into a retirement plan, for example, that's okay, because you're diversified. Money you need for your cash needs is already out of the stock market anyway, so you're not forced to sell more shares into a down market to get the same amount of money and have what's called the negative sequence of returns. So either way, you're prepared for it. This is why cash is so important. When people say, especially, I hate to sound the same way, but when financial media people, I'm not talking the journalists, I'm talking about the people who were interviewed, they say cash is trash. One guy, I won't say his name, Kevin O'Leary, Mr. Wonderful, he's like, oh, I think, you should protect yourself with stocks that pay dividends. Plenty of stocks pay dividends that can raise prices. Well, those stocks are going down too, and they go down too in a bear market. So how do you define protecting yourself? Some people say, well, I'm protecting myself by being in stocks that will probably go down less than the overall market. How about you protect yourself by keeping some of your money in cash, so you have an opportunity to invest that cash into a down market, or you use that cash for cash needs so you don't have to sell other securities that are down while the market's down, because we all expect the market will recover one day. Now, I don't know if this is a year or two. Like, the NASDAQ went down like 80% in the year 2000. Right now, the NASDAQ's down like 25%, 26%. It's not, we could go down a lot lower, and everybody's looking for this grandiose bottom. Like, oh, this is it. We hit the bottom, and it's time to just jump back in, and we're going to go right back to the top. People are looking for this giant snapback rally. Let me tell you, first of all, it's not, I don't think it happens. Bottoming is not an event, it's a process. And you don't know how long it's going to take for the process to play out. You don't know how bad the process is going to be, or how much the market's going to go down while we're in the process. Coffee. But if it's a process, you could invest cash a little bit at a time, sell a little bit at a time. Rallies during bear markets, where the market goes up, like an up 1,000 day. And I told you that last week when the market went up 1,000, I didn't change anything. I didn't sell. It didn't cause me to sell. It didn't cause me to buy. It's just another day. Okay, you've got to be calm. I'm not making an investment move just because the market went up or down 1,000 on the Dow. I'm making an investment move based on the company specifics, or if it's in a particular client's account, the move has to be appropriate for the client's financial situation. And I know what you're thinking. Well, doesn't everybody want to make more money? Isn't making more money always appropriate for a client's situation? The answer is deeper than that. The answer is, when are they going to need the money? That's like the main part of it. When, because your time horizon is what dictates your risk tolerance. So these are the things that we're taking a look at. Let's go to the big board and let's go to the screen and take a look at a couple things. Okay, pop myself up here. All right, so the Dow down 650 points, down 2%. Nasdaq, this is big. This is a really big down day. Nasdaq down over 4%, down over 500 points. S&P down 3.2%. That is a lot, down 132 points. Gold continues to go down. There's like no safe haven help from gold whatsoever. Gold just cannot stay above 1900. The oil down over $7. That took the wind out of the energy stocks, which typically has been a good place to be, but energy stocks got pummeled today. U.S. Treasuries, the 10-year, the yield came down a little bit, but basically where it was on Friday. No flight to safety, though, into bonds. Usually when stocks get pummeled, people run into bonds, right? And very little of that happened today. And let's take a look at the VIX. The VIX up 4.5 points, up 15%. That's a pretty good amount. People worried about fear. Let's take a look at treasuries. Yields came in a drop across the board, but the 10-year, again, still over 3%. Just a little bit of money went into U.S. Treasuries as a flight to safety, but it barely moved the needle. I don't even think it's worth talking about. And crypto tanked. When you see crypto down 10% in a day, 9.93% of Bitcoin. So Bitcoin is well below 32,000. It's 31,000 and change. It was just like 41, 42,000 like a week and a half ago, and people getting excited about it today. So your make pretend virtual currency is causing you real world losses now. I bet a lot of people bought the stock. It went to 60,000 in the 60s within the last year. So crypto is getting hit too. It turns out crypto trades along just like, with tech stocks, except it's got a higher beta. So if tech stocks go down 3%, Bitcoin could go down 6%. I don't know if it's an exact 2-to-1 ratio. I'm just giving you an example that Bitcoin has a very high beta. So if you have a nice rally in Nasdaq stocks, you'll probably see Bitcoin have an even bigger rally to the upside. And that's how it goes. And I just always like to look at Ethereum. Ethereum 2300. That was over 4,000 not too long ago. See that? That was over 4,000 not too long ago. And where's the Doge? Where are you, Doge? The Doge, 11 cents. It was 25 cents for the longest time, went up to 70-something cents because Elon Musk touted it. When Elon Musk touts a stock, he's worth like $200 billion. What he sees as a good opportunity or a good chance to make money on something could be completely inappropriate for you. And this is why I don't advocate just doing what a billionaire does. Dogecoin has been a disaster for the people who don't have the financial sophistication to realize that, or who just followed Musk blindly into Dogecoin, are licking some wounds. Maybe it'll come back, but I don't like to be in things. You can't call Dogecoin a security; it's a crypto. But I don't like being in things that I have to wonder, will it ever come back? It's so speculative. I much prefer to be in things that if it's down, it's okay. I'll give it time, and time should bail me out. What I said a while ago on this show is the worst thing for crypto is a Fed that has gotten religion about fighting inflation, raising rates, tightening the monetary supply, reducing credit in the market, protecting the dollar. That's the worst thing for crypto. Crypto is completely based on not protecting the dollar, on a Federal Reserve and a government that prints too much dollars. Well, we printed, and now we're pulling it back, and you can see how it's affecting crypto. Same thing, by the way, goes for NASDAQ stocks or a lot of tech stocks, not all, but generally speaking, a lot of tech stocks. Now, let's take a look at the S&P 500 chart. This is going back a year. All right, so we're lower than we were a year ago. All right, May 11th last year, we were at 4,100. Now we're below 4,000. But if you look at a 5-year chart, we have come a long way. Now, if you look down here, can I make this bigger? All right. If you look down here, okay, this is where the pandemic started. Market tanked. It came all the way back here. So it's hard to say in the last 5 years that you're doing badly. All you're seeing now in the S&P 500 is we're just back to where we were in like March of 2021. It's a lot. It's a year and 2 months of gains have been wiped out. Not to say it's not a lot, but if you're a long-term investor and you've been investing for long term, you're still in pretty good shape and you don't have quite as much to complain about. And I just want to take a look at BND. This is the I don't know if this is I do think that this could be the biggest bond fund between this ETF, the Vanguard Total Bond Market Index, and their mutual fund version of this. If you take those two and add them up, I'm pretty sure that's your biggest bond fund in the industry. Okay. It was up ever so slightly today after it hit a 52-week low of 75.14. So it closed at 75.59. Just a tiny bounce off that bottom. But what you're not seeing is that, first, it's only paying 2%, 2.13%, but it's down almost 11% year to date. This is the worst bond market that I've ever seen in my career. I saw something that's like the worst bond markets is like 1,800 and something, somewhere a Wall Street Journal article over the weekend. But in my career, which started in 1990, this is the worst bond market I've ever seen, worse than 94. And in the last year, this fund is down 11%. So with stocks down 11%, bonds down over 11%, and this is not quite what I was looking for. Hold on a sec. And the S&P 500, so the bond fund is down over 10% year to date, and the S&P 500 is down 16% year to date. Usually, if bonds are up, so usually if stocks are down, you'd make it up in bonds, so bonds would go up, but they're both down double digits, and this is why diversified portfolios are not doing that great this year. Still better than just an all stock portfolio. Still a hell of a lot better than the Nasdaq. Still a hell of a lot better if you're investing in individual stocks. You just had a couple of losers, like the Zooms, the DoorDashes, Meta, which is Facebook, even Amazon. You're still doing better with a diversified portfolio of, let's say, 60% stock, 40% bonds between S&P 500 and the Vanguard Total Bond Index Fund. Okay. But these are the risks we take. I don't think the 60-40 portfolio is dead by any stretch. All right. So that's my story. That's what I'm sticking to, and I appreciate it. So let's not get caught up in the negativity. Don't make rash decisions and think you're going to sell everything and get back into the market at a better time. This is part of the process of writing them down, writing them up, writing them down. I know people who sold out in 1987 and have regretted it, and I know people who just held on to their portfolio and didn't do anything, and they're happy they did it. I don't know anybody who bought at the very bottom in 1987 or during the pandemic of 2020. All right. But the people who just bought and held on to things did fine. And that's what I'm going to encourage my long-term investor clients to do it myself. I don't want you guys making crazy decisions and just getting into all energy stocks and all consumer staples. It's not worth it. And I don't think it's going to help you long term. I think if anything, you wind up making bad mistakes that'll help that'll set you back even longer. All right. Thanks so much for watching. I'm Mitch Goldberg, Any questions that you want to ask, hit me up in the comments, and I'll speak with you tomorrow. Thank you.